Hey everyone, I'm Jeanette Birnbach. Welcome to lesson 4 in our crash course on real estate syndication. We've already covered what syndication is in general, the types of investor statuses and types of opportunities, and how investors get paid. And now in this 4th lesson, we're going to cover a topic that we get asked about all the time, which is tax strategies. So these are 4 things that you should know about taxes and passive real estate investing. And just so you know, I'm not a tax professional, neither is my partner Sanjay at Blue Ring Investors. And honestly, we don't want to be. It's a really tough job. But the insights and perspectives that we are going to provide come from my personal experience only in this case. You should speak with your CPA for more details and specifics on your situation. And if you don't have a CPA, we'll review 3 questions to ask a CPA if you're considering hiring one, and we'll look at that at the end of this presentation. All right, so that's out of the way. Let's get started. There are books, many books, about people who have regular jobs, but they still build a large net worth over the years. You may even personally know some of these people who've accomplished this. Conversely, I bet you also know or have heard of people who make tons of money and then have no net worth at the end, or even head toward bankruptcy. So Hollywood's full of these, professional sports is full of these, lottery winners are full of these. So we know those stories too. Now the difference between the 2 scenarios is straight up money management. Our money, whether we have a little or a lot, has to be managed. There is a huge difference between the way the IRS views stock market gains and the way that they view real estate gains. And the next 7 minutes or so, we'll review this from the standpoint of a passive investor in a real estate syndication. So here are the 4 things you should know about taxes and real estate investing. 1, the tax code favors real estate investors. Now, you may have heard that more people become millionaires through investing in real estate than through any other path. And believe it or not, the tax code actually helps them with this. The IRS recognizes how important real estate investing is in providing quality housing for people to live in. So the tax code is written in such a way that it rewards real estate investors for investing in real estate, maintaining those units, and making upgrades over time. So if we could say that the IRS likes anyone, it would be real estate investors. So as a passive investor, you get all the tax benefits an active investor gets. And this means that even though you're not actively dealing with the tenants or repairs, you still get full tax benefits. This is because as a passive investor in a real estate syndication, you invest in an entity, and these are typically LLCs, limited liability companies, that own the property, and that entity is disregarded in the eyes of the IRS. So these are sometimes called pass-through entities. That means that any tax benefits flow right through that entity to you, the investor. Common tax benefits from investing in real estate include being able to write off expenses related to the property, and including things like repairs, utilities, payroll, and interest, and being able to write off the value of the property over time. This is called depreciation. Depreciation sounds like a bad thing, but it's awesome. So let's look at that next. So here is point number 2. Depreciation is a powerful wealth building tool. So if you only remember one thing from this presentation, let it be this. Depreciation is one of the most powerful wealth building tools in real estate, period. Depreciation lets you write off the value of an asset over time. And this is based on wear and tear and the useful life of an asset. So essentially, the IRS is acknowledging that if a property is used day in and day out, and if you didn't do anything to improve it over time, it would succumb to natural wear and tear, and eventually it would be unusable. So let's say you purchased a property for $1 million, and the land is worth $175,000 and the building is worth $825,000. With the most basic form of depreciation, known as straight line depreciation, you could write off an equal amount of that $825,000 every year for 27.5 years. So that means that each year you can write off $30,000 due to depreciation. This is a big deal, and here's why. So let's say that first year you make $5,000 in cash on cash returns from the cash flow on that property, one of the ways that investors are paid. And instead of paying taxes on the $5,000, you get to keep it tax deferred without having to pay taxes on it until the property is sold. I have to put in a disclaimer. I already mentioned we're not CPAs, so I'm speaking in general how this goes, but you have to speak to your financial advisor about your individual tax situation. And back to our example, the $30,000 in depreciation means that on paper, you actually lost money, while in reality, you cash flowed $5,000. Plus, properties that have been acquired after September 27th of 2017 are eligible for bonus depreciation, which can really amp up tax benefits for that first year. And a knowledgeable CPA will understand how to make the most of this. Point 3, cost segregation is depreciation on steroids. On the last example, we talked about something called straight line depreciation, which allows you to write off an equal amount of the value of the asset every year for 27.5 years. But for most of the real estate syndications, like we offer at Blue Ring Investors, the ones that we invest in, the whole time is just around 5 years. So if we were to deduct an equal amount every year for 27.5 years, we'd only get 5 years of those benefits. We'd be leaving 22.5 years of depreciation benefits on the table. So this is where cost segregation comes in. Cost segregation acknowledges the fact that not every asset in a property is created equal. And what that means is that the appliances maybe are going to last 10 years or less, the carpets may last 5 years or less, but the roof, the structure of the building could last much longer. In a cost segregation study, an engineer who specializes in this will itemize the individual components that make up a property. So they'll include things like outlets, wiring, windows, carpet, fixtures, and certain items can be depreciated on a shorter timeline than that 27.5 years. So they come back with 5, 7, and 15-year designations with a cost segregation study instead of just that 27.5-year designation. So this can drastically increase the depreciation benefits in those early years. Cost segregation has truly been a game changer for real estate investors. Now, the IRS likes to be included in everything. So real estate, of course, is not 100% tax-free. In real estate investing, the way they get their cut is through capital gains taxes when a real estate asset is sold, and sometimes through depreciation recapture, depending on that sale price. In a real estate syndication that holds a property for 5 years, you wouldn't have to worry about capital gains, taxes, and depreciation recapture until the asset is sold at year 5. The specific amount of capital gains and depreciation recapture depends on the length of the hold time, as well as your individual tax bracket. And there's a breakdown of how those tax brackets work on this slide. For more details and the most up-to-date laws and info, I recommend that you discuss those specifics with your CPA. The fourth and final point is that some people literally invest in real estate solely for the tax benefits. The tax benefits of investing in real estate are so powerful that especially wealthy people do so purely just to get those benefits. And this is how real estate tycoons can make millions of dollars but owe next to nothing in taxes. It's completely legal, and it's a powerful wealth building strategy. And you don't have to be wealthy to take advantage of the tax benefits of investing in real estate. The tax code makes the benefits of investing in real estate available to every real estate investor. I want to mention, of course, the famous K-1 document. Investing into private real estate offerings such as syndications enable passive investors to access tremendous tax benefits that we've already looked at. These tax benefits are passed down to the passive investor in the form of a document issued by the IRS, and that form is called a Schedule K-1 or Form 1065. Schedule K-1 is used to report the beneficiary's share of the estate's or trust's income, credits, deductions, etc., on your Form 1040, which is your U.S. individual income tax return. Your syndicator will provide this document to you, and you hand it over to your CPA every year. That's all you have to do. The CPA will know how to take it from there. Now, here's some questions to ask your CPA. And if you don't hear answers you like, You may have the wrong CPA to move into the future with you as a real estate investor, or you could also use these questions if you're interviewing someone that you might want to work with as a CPA who's knowledgeable. So first question is, do you have other clients that invest in syndications? This should be the first question that you ask the CPA, followed by, do you personally invest in syndications? If your CPA has no experience personally or professionally with syndications, it would be unlikely that they could properly advise you. However, if your CPA has a lot of clients that invest in syndications or they invest themselves, they understand what to look for in a good investment and what to avoid. They can better understand how syndication will fit into your overall tax strategy and your investment plans. Here's another question. How much time do you spend working with your clients on their strategy? Take some time to get a strategy. Your best bet is to have a strategist for an accountant, not just someone who plugs in numbers. The ideal situation is where you can sit down with your accountant frequently, at least quarterly, to discuss your situation, what's changed since last time you got together, and proactively plan for how to maximize your tax savings. It's also optimal if your accountant is available for questions to help you with decision making. When you interview an accountant, I recommend you determine if they're real estate savvy and find out if there's kind of a personalized touch that's available, and if there is, what will that cost you? And finally, how can I use my passive activity losses to my advantage? A common misconception among passive real estate investors is that you can use the passive losses from a syndication to offset your active or ordinary income. But for accredited investors, these losses do not offset your active income, but they may offset active income after the property is sold. So this creates an interesting tax planning opportunity if you have passive income from other sources, or you can invest in other passive investments that generate passive activity income. Something like rental real estate, oil and gas investments, or other limited partnerships would qualify. So there's a summary of the 4 things that you need to know about tax strategies. The first was that the tax code absolutely favors real estate investors. Depreciation is a powerful tool. Cost segregation is depreciation on steroids. And some people invest in real estate solely for the tax benefits because they are so good. And most likely, you won't have to worry about taxes when investing in real estate, especially as a passive investor in a real estate syndication. In most cases, you'll be able to make money with your cash on cash returns, yet you won't owe taxes on those returns due to the benefits like depreciation. As a passive investor, you don't actually have to do anything to take advantage of the tax benefits that come with investing in real estate. You don't have to keep any receipts or itemized repairs. You just get that really awesome K-1 document every year. You hand that over to your accountant, and that's it. So thank you for joining me for our crash course. If you have more questions, we'd love to hear them. You can reach us at www.blueringinvestors.com, where you can email us, or you can set up a consultation call with myself or my partner Sanjay. And we have other free educational resources on this site as well. So please, when you get a few minutes, have a look over there. And if you reach out to us, we'll get back to you right away. And we're looking forward to speaking with you. Take care. Thank you.